when you drive around in Bangalore, you see D-Marts everywhere, right? But honestly speaking, and maybe you have, but I honestly haven't seen a single Vishal Mega Mart around. And now I see it's got a 10,000 crore revenue. So how is that possible?
That's because you're a privileged little brat.
Why? Because I'm on Lavelle Road and there's no D-Mart here also.
Yeah, I mean, yeah, that way.
Hello and welcome to yet another episode of Taking Stock. This is a weekly podcast where every week we pick one company, one stock, and we dive into it. This week we've got a meme company. Not a meme company, but a company that got very popular and was in the news because of a meme. So did you see this Vishal Mega Mart security guard meme?
Yeah. So popular.
I was just searching for it on Google and I saw a picture of Cristiano Ronaldo with a security guard cap.
You know, the surprising part though is that, I tried to find the original hiring post or whatever.
And it's not there.
It's not there. So apparently, some people then say that it got traced back to this one LinkedIn post about someone who did the interview or whatever.
So what was the meme about essentially? They were hiring security guards.
Yeah.
Right? They
like
put
a
out
mass
an ad.
drive for it.
Okay.
But they had a very stringent application process for it, where the written exam was there. Then they preferred people with martial arts training and all of that. So, and apparently, people said that the pass rate was only 1% or something. So it's you better be proud of doing this.
Tougher than the army.
UPSC and all of that is also
Yeah, that's what, because I was just seeing, right, that their stock has delivered a 35% return last year. But when you search for it on Google, this is what comes up first. But anyway, so the stock we're talking about this week, if you haven't guessed yet, is Vishal Mega Mart. So let's go right into it. First question that I've got, right? Firstly, is that in this exact space, D-Mart is obviously the most known player. I don't know if that's the right word I'm using, but D-Mart is the popular player. When you drive around in Bangalore, you see D-Marts everywhere, right? But honestly speaking, and maybe you have, but I honestly haven't seen a single Vishal Mega Mart around. And now I see it's got a 10,000 crore revenue. So how is that possible?
That's because you're a privileged little brat.
Why? Because I'm on Lavelle Road and there's no D-Mart here also.
Yeah, I mean, yeah, that way. No, but the thing is, Vishal Mega Mart caters to a very different audience than what we are.
Okay, fair enough.
So most of their stores are in tier 2 and tier 3.
Understood.
They're not really in tier 1. I mean, they are, but not in a significant way.
Right.
And these guys, so the primary target market is middle and lower income groups. And if I want to use a better word, they're value conscious buyers.
Fair enough.
Which is the target. So roughly we're talking about a family level monthly income of about 40,000 or lesser.
Okay.
So they will also, even if they're present in tier 1, which they are, they would be present in certain localities which have these categories as majority dwellers.
Understood.
If I may. And hence we've not perhaps come across Vishal Mega Mart so much.
So they are mainly present in smaller towns, tier 2, tier 3 cities. But in those places, they are the go-to place when it comes to your, your family shopping and your grocery shopping and all of those requirements.
Yeah. So see, essentially, if I have to put some numbers to it, right, they've got some 740 stores at this point. 742 to be precise. So that is a large number of stores and you've not even come across one.
Correct.
Right? So that's the whole thing. And
that's what I'm honestly trying to think, right? That even when you sort of, and I know you think I'm privileged, but I've been to tier 2, tier 3 cities also. But I honestly don't, maybe I've not paid attention or just the brand recall wasn't there. But obviously they're doing something right with having achieved a 10,000 crore revenue, right? But even when I was sort of reading through their story a little bit, I realized that they've been around since 2001, right? It's a 24-year-old company. But for the first 10 years, they were almost bankrupt.
Yeah, that's another reason why you haven't heard of it, right? Because the company started in 2001, and then it went to about 170 stores by 2008.
Right.
And that's when, but the expansion at that point in time was not very healthy in terms of they were taking a lot of debt
Losing
to operate,
money, etc.,
losing
yeah.
money and all of that. So basically 2008 also you have to remember that it was the global financial crisis year. So things were pretty bad economically at that point. And that's when these guys accumulated losses of about 750 crores at that point. And they had to sort of say that, okay, we need to dramatically change something.
Correct.
So they were near bankruptcy, and the promoter of the company sold the entire stake to TPG Capital and Shriram Group.
Okay.
And that was a distressed sale.
Right.
So it was at a very meager valuation
Right.
compared to, I mean, anyway, the losses were also 750 crores, but
Correct.
still, compared to the invested amount or whatever.
Right.
And after that is when things sort of started going north again after that, after the promoters changed.
Right.
So once this happened, they actually got a veteran from HUL to become the CEO. And then they actually shut down 100 of the stores.
Right.
So the first thing was to cut out the flab,
Correct.
trim the excess,
And make it a little more efficient, and then
consolidate.
and then they sort of restarted into
So you
expansion.
clean up first and then you go back up.
Right.
So the next 7 years were just about sort of cleaning up and then refurbishing the business and
Right.
growing. So
Understood.
that was a growth period, but I think that was also a period where it's up, it goes down, it comes back up.
Right.
That was the period. After that, after 2018 is when TPG and Shriram Group, they have sort of sold the stake to this one, Kedara Capital.
Right.
So Kedara is when things really started sort of changing. And this is where I think the next leg of growth started. More popularity happened. So 2019 to 25 was sort of doubling down on what worked in the previous cleanup and growth act.
Right.
And now you're coming at then whatever 500 stores, now about 750 stores.
Correct.
So this is where popularity is starting to come back.
Right. So
for
this
the
is
company.
so the real success story is. I mean, I understand the comeback and sort of the beginning of the success story started in 2011, and the first 2011 to 2018 was more of cleaning up and sort of setting the stage for this big success story. And then the last 6 years or so is where they've actually gone double down and gone big.
Yeah, I mean, they went big even from 2011 to 18. So, for example, they went from, say, 150 odd crores of revenue, around that much, to about 1300 crores.
Right.
So, that's also near 10x during that period.
Correct.
And from 1300, they've gone to 10,000.
10,000.
But as a brand, it becoming popular happens after you reach a certain scale, right?
Right.
And that happens more at 10,000 crores than a 1,000 crore company.
True.
So it's not only because of your privileged background that you haven't heard of Vishal Mega Mart. And then, of course, there's the IPO. So
After this podcast, I'm going to go to Vishal Mega Mart and shop something.
you find one first around here.
Just to prove I'm not privileged.
So anyway, so the IPO is also the popular type, right? So November 2025 right now, the price is somewhere around 137. The IPO price or the listing price was 78. And there was a listing gain because the stock closed at 110, 112. That's when people actually must have, at the IPO time, realized that this is a company, looks great.
So which year was the IPO?
1.5 years back, I think.
Okay, fair enough.
Yeah.
This episode of Taking Stock is brought to you by Paterson. So obviously, okay, so let's go slightly deeper, right? Clearly, the first 10 years there was something wrong. They went through a distressed sale, and then since then there's been a big comeback, right? To say the least. Now, what's gone right for them? What have they done right that's sort of caused the success story? And obviously, it seems like it's going to continue.
Yeah, so I think when it comes to retail, there are three things which are very important, which these guys seem to have cracked.
Okay.
Number one is where you're selling.
Okay.
Second is what you're selling. And third is how you're selling.
Fair enough.
Right? And by where, I also mean to who.
Correct.
To who becomes a subset of where.
Where, yeah.
Right. So I think it's great if we'll cover one by one the three aspects.
So let's start with the where.
Yeah. So as we've established, it's in untapped tier 2 and tier 3 markets.
Correct.
Which are 90% unorganized. If you look at tier 1 markets, they are about 25 to 30% organized and the rest is unorganized.
Right.
Tier 2 and 3, 5 to 10% is organized and the rest is unorganized.
Right.
So the unorganized to organized shift has to happen in tier 2, tier 3 to a much larger extent.
And they are sort of leading that charge.
They're leading that. So if I sort of have to look at their store, this thing, right? About 75% of their stores are actually in tier 2 and tier 3.
Understood. So when you say, okay, so let's dig deeper, right? If when you say that, okay, we're going from an unorganized to an organized market, and in tier 2 and in smaller towns and tier 2, tier 3 cities, the market is 90%, 95% unorganized. So you're saying there's a lot of situations where they are the first sort of supermarket of that particular town or a city.
Yeah.
Right.
So they are one place which, okay, so one of the other things is they are also, so they do three things. Primary categories, right? They do apparel,
Right.
They do general merchandise,
Right.
which is your utensils and
Correct.
soap, shampoo, personal care, etc.
Right.
And the third thing they do is groceries.
Right.
Now, if you look at the others, if you look at DMart, for example,
Right.
80% is groceries.
Groceries and little bit of
20%
personal
would be apparel and personal care and
Right.
stuff like that. So that format of having everything together
Correct.
in a tier 2, tier 3 becomes the selling point.
Right. Understood.
The selling point, actually we'll come to those also later in terms of how they're selling, etc.
Right.
But the primary proposition is that they are giving them an organized shopping center sort of
Right.
a experience.
You're literally giving them a one-stop shop.
Yeah. And you're also giving them premium feel branded products
Correct.
at very affordable prices.
Understood.
That's the proposition. So
Right.
because tier 2, tier 3, you don't have too many brands going there.
Correct.
These guys are able to get branded products at very affordable costs, and that is the proposition, because everybody is aspiring to own something which is branded, which is new, which is whatever, right? So where they're selling, again, that becomes important, because that's where tier 1 is where DMart is sort of playing. They are sort of saying that they're playing that Walmart model or whatever, right?
Correct.
You have one large space.
Right.
So if you look at Vishal Mega Mart, their average size of the store is about 17,500 square feet.
Okay.
This
And
is roughly
in comparison with DMart, it's smaller.
40,000.
Okay, so less than half.
Less than
essentially.
half,
Right.
yeah.
Right.
Also because, I mean, that's not only a function of a choice of like, okay, sorry. So the other thing also is that tier 2, tier 3, if you look at, economically, they're not going to spend as much as tier 1 folks.
Correct.
Because the total per capita income itself is going to be lower.
Right.
So the spending capacity is going to be lower.
Right.
And hence, if you look at these guys versus DMart, they are probably doing half of what DMart does in terms of revenue.
Understood.
With double the number of stores. So
Right.
that equation is because per capita spend itself is going to be lower. Because again, you're
Understood.
talking about income groups of 40,000 or lesser.
Correct.
So the spending ability is lower.
Of course. No, absolutely makes sense. So fair enough, right? I think they've nailed the where to sell.
Yeah, because there is no competition.
Huh.
I mean, there is now competition because other players are coming in, like there is a V-Mart,
Right.
there is a V2 Retail, which is the
Okay.
ex-promoter of Vishal Mega Mart.
Right.
But they're in different categories and they have different positionings also.
Correct.
So there is a lot of new players coming into tier 2, tier 3, but these guys were sort of leading that change.
Correct. Makes sense. This episode of Taking Stock is brought to you by Paterson. Right now, okay, so in terms of what they're selling and how they're selling, what have they got right? What's going right for them?
So in terms of what, it is very simple. As I mentioned, general merchandise,
Correct.
apparel, and
Personal care.
groceries.
Okay, personal care is general merchandise.
So-
Fair enough.
Their hook is that they'll get people in for groceries and they'll end up selling apparel and other stuff as well.
Correct.
Now, very smartly, if I sort of analyze, I mean, generally how their stores are made, the ground floor is usually apparel. First floor will be general merchandise. Second floor will be your groceries and FMCG. So
You
your
have
hook
to
is,
essentially go through
Yeah.
everything to reach your groceries. Yeah.
and in the process you will
Your
come
kid is going to
across.
say, Papa, please get me some t-shirts, and then you have to buy.
Yeah, so that's the whole game, right? So in terms of what they're selling, the other differentiator is that they're basically selling their own brands. So they've got a bunch of products
Right.
which they're using contract manufacturers to make. And then they're able to price them lower because these are their own brands.
Correct.
They're not spending on advertising at a national level and all of that. The advertising or marketing strategy is that people walk in. Footfall is the driver.
The strategy. Correct.
So you're saving on brand and advertising cost. You're saving on, say for example, Britannia will sell you something.
Right.
Then you will sell to somebody else. There's a margin that also goes there.
Correct.
So basically, what they're selling is private label stuff, which is 73% of their total revenue.
Understood.
Which enables them to sell at about 15 to 20% lower prices.
Right.
At least compared to nearest competition.
And you're dealing with people who are extremely price conscious.
Price sensitive. Yeah. So again, so it ties in with where you're selling.
Correct.
Price sensitive users.
Right.
Also, where you're selling, because you're setting up in tier 2, tier 3 cities, the rental is much more lower. The space you're renting out is going to be, the cost is going to be lower. And hence the operating cost itself of this company is lower, and hence they can provide further discounts.
Understood.
So they are nailing operational efficiency and hence lowering the price and catering to this market beautifully.
Understood.
So if I look at the private labels, right? I mean, so for example, they're even competing against a Maggi. So instead of Maggi, they place something known as a first crop brand, which their brand only, which is 33% cheaper compared to Maggi. Then there is in biscuits there, instead of Good Day, they have again got first crop, which is 20% cheaper. Pressure cooker, instead of Prestige, they have an electronics brand also called Tandem, which makes sound bars and which makes all sorts of stuff, and again 20% cheaper. Shower gel, instead of Nivea, you've got Outshine, which is 50% cheaper. So they are attacking the market by just getting stuff done 35, 40, 50% cheaper compared to the nearest competitor.
That's fascinating.
Beautiful stuff when it comes to, and see, general perception also is that if you're gonna be, I mean, these brands are not known, there's gonna be a trust factor, right? But and the other perception problem is that if you're getting something cheaper, that to 25, 30, 40%, maybe there is a quality issue. So what these guys are ensuring is that they're tying up with very reputable contract manufacturers. So for example, their biscuits are actually made by Bikaner Wala, which is a great brand. Their coffee is made by CCL Products, Consolidated Coffee. The noodles are made by Indonesin. So they are tying up with manufacturers who are reputed, who are making quality products. But
so the products of a high quality but sold at a discounted price, which is the perfect combination from a consumer point of view.
From an aspirational consumer standpoint, who obviously has access to the internet and is saying, "Yaar, mereko bhi ye ramen khane ka hai." So he is getting that ramen for cheaper, right? So I mean, they're able to hence do a very beautiful job at what they're selling. And the other thing is, again, going back to the mix of, and I'll tell you why that is important, of doing apparel as well as grocery as well as general merchandise. Generally, the lowest margins are in groceries. Fruits, vegetables, shelf life, whatever, pricing. So you have 10% roughly gross margin in groceries. Right? However, in apparel and in your other general merchandise, gross margins are about 30%, 35%. So basically, if you have a good mix between apparel, general merchandise and grocery, at a group level, you are able to make much more margins. So, in a way, what happens is if you are able to sell some higher margin products, you are able to subsidize further some of the other stuff in terms of pricing, because your blended gross margins turn out higher. So, these guys, for example, if I compare to DMart, DMart is 80% groceries, 20% apparel and gen merch. In that, they make about 14% gross margins. For someone like Vishal Mega Mart, the gross margin at a blended level comes to about 28%, which is double that of DMart. So half the store size, very diluted brand compared to them, not heard of it, but supremely profitable when it comes to margins. So their overall mix is, currently they have about 44% coming from apparel, 28% coming from FMCG, and 28% coming from general merchandise. That's the rough mix of their revenue, which is very different compared to any of the competition. Whether it is DMart, VMart, whatever else.
V2, all of those. Yeah. Fair enough. This episode of Taking Stock is brought to you by Paterson. So now one thing that I'm sure everybody also has a question on their mind, right? That obviously the 10,000 crore revenue, and this 10,000 crore was last year, right?
Yeah, FY25.
FY25, yeah. And so you said they're also killing it in terms of how they are selling. What does that even mean?
So primarily going back to our pricing point. So one is in general how their stores are placed.
Right.
What their mix is, how they're selling, primary has to do with pricing.
Okay.
In terms of just being able to price much lower. But how they're selling also is not just function of like on the demand side. Also, I want to cover a little bit in terms of how they're operationally much better.
Okay.
So basically the entire model, because they are contract manufacturing, they have much better control over product, inventory, etc., right? Additionally, if I look at the EBITDA margin of Vishal Mega Mart, it's at about 14% compared to DMart, which is at about 8%.
Okay.
So one is there is a difference at a gross margin level because of the mix.
Right.
However, despite lower pricing, they are able to do a much better job at EBITDA because so there are a few things that they do right. So for example, they have fewer staff.
Okay.
Compared to your other stores. They also sort of play around with power during lean hours.
Okay.
Smartly sort of say that lighting during a Wednesday afternoon when there is nobody shopping will be
lesser. Yeah, they're saving costs. Yeah.
Your entire store does not have to be freezing chill like your apparel stores.
Correct.
Maintaining a certain aura.
Right.
They have a very strong hub and spoke distribution model when it comes to sourcing their products, getting it to one place, distributing further to tier 2, tier 3 cities.
Right.
So that is more efficient. They don't have much of a premium look in their entire store.
Correct.
Like for example, if you go to a Zudio, the proposition is same.
But it feels
for
premium,
apparel, it is offering premium quality products at affordable pricing.
Correct.
That is what Zudio does.
Right.
That's why you don't see a Zudio on Lavelle Road.
Right.
That is not their market.
Correct.
But the look and feel matches to any of the stores you see here.
Right.
So Vishal Mega Mart is not really playing that game at all. So they are doing much better at a unit economics level, and this is where it is very interesting if we just sort of dig deeper. Where, for example, their 10,000 crore revenue is coming from 742 stores. Right. So roughly what is happening is at a per store level, this is where the analysis is pretty interesting.
Correct.
So revenue is roughly 16 crore per store.
Okay.
Annual.
Fair enough.
Right? Now the gross profit comes to 5 crore.
Okay.
Because you're buying the merch that you're selling, right? So gross profit comes to about 5 crore at a store level. Employee cost for every store would roughly be 50 lakh per annum. Okay. Your staff and cleaning and blah blah.
Correct.
Rental is about 85 lakh. Okay. Other expenses are 90 lakh.
Right.
Electricity, this, that, utilities. So the total cost of running the store comes to about 2.4, 2.5 crore.
Right.
5 crore is the gross profit.
Yeah.
2.5 crore is the running cost. So you're left with an operating profit of 2.5 crore.
Correct.
Per annum.
Right.
Per store.
Right.
Now, if I take a step up, here's the thing. To set up a store, you require capital expenditure, right? Because you have to do the interiors, you have to do whatever. Setup required.
The setting up the cost.
That will cost about 2 crore per store.
Okay.
Yeah. Inventory buying, because you have to sell, will be about a 1.5 crore.
Right.
To start with.
So it's a 3.5 crore setup cost.
3.5 crore setup cost. Your per annum operating cost is profit is 2.5 crore.
Correct.
So roughly your payback period is less than 2 years.
Correct.
Between about 17 to 18 months, the
You're
store has made up the entire amount of money. So where I'm getting at with this is that if that is the period you're talking about, the operating cash flow of the company itself is enough to fund in a healthy manner growth for the company in a very aggressive manner.
Correct. Because they can keep opening new stores because the payback or whatever, the payback period isn't 5 years or 7 years or whatever. Right.
So in terms of how they're selling, the operational efficiency and the model itself enables them to do a much better job at aggressively expanding and doubling down on building more brands, getting a better product portfolio, opening new stores more aggressively than competitors.
Right.
So even if competition does come into the same space, these guys, because of this model, are able to do it
Grow
much more
faster.
efficiently.
Yeah. Makes sense. So with that logic in mind, keeping this in mind, what that means is that this 742 can realistically become 1,000 and above in a short span of time.
Yeah, so what's happened is that over the last 3 years, 21 to about 23, 24, if I look at, they've been roughly adding 55, 60 stores per annum.
Right.
That has increased now. Last year, they added 100 stores.
Right.
This year, I think they've already added some 55, 60 stores in half the year. So basically, the management is saying that these guys can sustainably add 100 stores per annum for the next 15 years.
Correct.
Which is supremely sort of...
it's ridiculous.
Yeah, so again, like going into the math of this a little bit, right? If I have to look at 100 stores, we are talking of 3.5 crore of cost
Investment
in setting up the store.
Right.
You're looking at hence about 350 crore rupees worth of spending.
Right.
These guys on a 10,000 crore revenue make an EBITDA of about 15-30 crore.
Okay,
which is about 14% margin. Their cash flow from operations, because there is a certain lease payment also which does not reflect in the EBITDA but has to be deducted because it is a cash item, results in a cash flow from operations of about 830 crore. In FY25. That's what happened. So 50% of EBITDA. If they're generating from operations, if they've generated 800 crores worth of cash, to add 100 stores, they have to spend about 350 crore. In addition to that, some refurbishments will happen in the existing stores. Still, they have a lot of cash, which can just
close
go
to
into
about 500 crores, or let's say even 400 crores, assuming refurbishments, etc.
Yeah, they'll still have additional cash every single year, which will just keep adding up. So I think from that angle, they're in a great place from a financial standpoint, and hence that also sort of explains that their balance sheet is debt free. They're able to fund their growth, unlike that first period of bankruptcy that we spoke of when they took on debt. And that happens with a lot of retailers, because when the margin is thin, you're not able to fund your growth unless you take debt. And that's happened with the Bianis also, for example. In this case, because your margins are higher and because you're lean operating and because your payback periods are lower, you see how it's all adding up.
Understood. So they are funding their own growth. They don't have to depend on debt. They don't have to sort of take on any other extra risks.
And that's why it's a beautiful space to be in and a beautiful model to operate. And hence it's working, and hence people are also noticing the company and being really gung-ho about it. Because the financials also look great. And I mean, that growth at the end of it, when you look at 100 stores per annum, for example, just to sort of put context in terms of what that means for growth. So roughly what that means is that if I just have to break this down into a couple of parts, for revenue, for example, for these companies, what matters is two things: number of stores that they add, and there is a metric called same store sales growth. SSSG. Which is the same store which was there last year. How much more revenue are they doing?
Added,
Because inflation, product portfolio changing, more footfall, higher wallet share. Because these guys, again, because they're catering to 3 different categories, they have a larger access to the wallet share itself of the customer. So basically, I have to look at 2 metrics when projecting numbers for someone like a Vishal Mega Mart, which is one, how many stores will they add? So if I look at 750 stores right now, 80 to 100 stores will be added, say next year. That will reflect about 10 to 12% growth. On top of that, they have consistently done 10 to 12% SSSG.
On the existing stores.
So you have to keep in mind that same store sales growth is also a relevant metric, probably only for 75-80% of the stores. Because 10% is getting added now. 10% is somewhere between addition and maturity. Because stores also take time to mature. People will hear about it, then footfall will increase, then it will sort of come there. So if I have to take a combination of the two, these guys can sustainably, I feel, grow at 20% CAGR, which they have delivered in the past as well, for the next, say, 3-4 years.
Understood.
and beyond, but I don't want to go on to beyond right now.
Right.
At least if we talk about 3 years, can they deliver 20% growth? This is how it would break down.
Understood.
Maybe there is not enough room left on profitability because they're already at industry leading margins. Their mix is already optimum. They're already contract manufacturing. They're already doing economies of scale. So how much more will you squeeze that? So I wouldn't be too gung-ho about margin expansion from here.
Understood.
But yeah.
So again, right, this is, I mean, everything that we've spoken about from the meme all the way up to the balance sheet of the company, everything looks positive and great, right? So, but do the valuations reflect that?
Valuations, exactly. So, I mean, this is a great story. And the valuations are also hence expensive. The stock has done extremely well since the IPO.
Right.
In fact, even before the IPO, whoever has invested at whatever point in time, they've seen 10x growth, and hence the company's done really well. So they are very on point in terms of execution as well. And that is unfortunately reflecting in a good way in the valuations. But unfortunately, I'm saying because then it becomes difficult for you to enter and justify an upside from here. Because the story is sort of priced in. Then what do you get if you're a new investor?
Correct.
That's the whole thing. So if I look at, so simple logic, right? If I put in 20% growth for the next 3 years, and keep the margins constant basis what we've spoken about, the P on the 27 earnings comes to about 68 times.
Okay.
And on 28 it comes to 56 times.
Right.
And EV EBITDA will come to about 30 times on a FY27 basis and 25 times on FY28.
Right.
Now this is at a 20% premium to retail peers like DMart, Trent, Vedant Fashions, ABFRL, which is Aditya Birla, Raymond, Go Color, Shoppers Stop.
Right.
If I sort of combine these and look at the valuations, it's at a 20% premium to
So Vishal Mega Mart has a 20% premium for these. Okay.
To an average of these.
Right.
And it has a about 60 to 70% premium to the value fashion guys.
Right.
Which is primarily your
Trend.
No. Value fashion will be again V2 Mart.
Understood.
So there is a very steep premium. The problem is, I as an analyst even found DMart something, to be expensive.
Right.
This is at a further premium to that.
Correct.
There are reasons for it to be premium. All those reasons that we spoke about throughout the last few minutes.
Is why the premium is there. Yeah.
Is why the premium is there. But here is why I feel it becomes a little difficult, or there are certain risk factors that also you need to take into account while giving it this premium, wherein I become a little skeptical.
Right.
Number one is the dependence on contract manufacturers. There is a dependence on private labels.
Correct.
And those private labels are manufactured by contract manufacturers. So there is a very high dependence there. If something goes wrong there, if supply is not there, if
prices
whatever
increase over
happens, if there is inflation is actually, I'll touch that later.
Right.
But that is one piece which I'm a little scared about.
Right.
Second would be inflation, because your key proposition is pricing.
Correct.
Everything is based on that one pricing angle, because it is a price sensitive user.
Right.
Nothing else matters.
Yeah, there's no concept of loyalty exists, because if there's somebody offering a better price, you might just switch.
Or if your product quality hampers and your price remains the same, there is a switch.
Right.
Or inflation increases and the cost increases, you can't pass the price on.
Correct.
And then everything collapses, because everything, even your operational model is based on the fact that it is tight, it is efficient, it is low cost, it is whatever.
Correct.
So everything goes for a toss.
Right.
So that is the second risk factor that I would want to accommodate in these premium valuations.
Right.
Third is competition. If this is such a great space and they have pioneered the model, they have given a playbook and a cheat sheet to everybody. You can replicate it.
Correct.
It will take some time. It's not easy.
Right.
It's a very heavy execution job, right? But somebody with deep pockets, somebody with that vision, somebody with that access can do it.
Correct.
The other risk is quick commerce, which is not such a big risk for tier 2, tier 3 right at this point, because penetration is not there.
But the penetration will happen. It's only a matter of time.
Yeah, and hence I am a little skeptical of, because a lot of these broker reports, right? For example, because the multiples are so high,
right?
And because this is a 10-15 year story, because management is also saying 100 stores for the next 15 years. And tier 2, tier 3 will continue growing at a faster pace inherently.
Right.
a lot of people are taking a 15-year view to justify the valuations or to come up with a DCF model to justify the price. My problem with that is that then quick commerce has the same effect that it had on tier 1 in that period of time. So then my visibility reduces, and hence I don't want to rely on a DCF. So that's the other problem. These guys are also enabling quick commerce, so they've sort of made delivery enabled. They've got their own app. They're offering loyalty programs and discounts on apps, etc. But quick commerce internet-led sales is only 1% of their total revenue right now. Which is barely 100 crore, 120 crore, right? So which is not really material.
But an increase in that or a positive movement in that could actually be a bit of a game changer, right?
Not really, because then the competition, which is quick commerce, operates out of dark stores. Here you're giving an experience at least. So what I spoke about, say for example, Zudio versus this guy. This guy versus dark stores, the economics are again different. So how will you compete there? So unless you change your business model, we may not want to dwell too much into that area, because tier 2, tier 3, again, it's not like a metropolitan, because again, dynamics are different. It's not far away.
There's not that much traffic. People
time on your
maybe
hands.
look forward to that whole experience of actually going to a store, etc.
So whatever, that is a whole different conversation which we can avoid or leave for another podcast. And the last problem is that right now Kedara Capital is the majority owner and promoter of the company. Kedara is a private equity fund. It will look at exiting at some point in time. It is not a business owner operator. It is at the end of the day, a financial investor who has to close the fund and give returns to its investors. So it is a financial investment from an angle. If Kedara leaves, and not if, when Kedara leaves, who is the promoter of the company? Who is going to drive this? Is another private equity investor coming? Or is it going to become a public company with a professional management? We don't know. So that is a little bit of a questionable risk. I mean, risk which is a large question, which I would also give a little bit of weight. So from that angle, I think
valuations are a bit iffy. Fair enough. This episode of Taking Stock is brought to you by Paterson. Okay, so it's time to move on to our community questions. For context, basically, we get a lot of questions across our social platforms, finance-related, wealth-related questions, and every week we pick one question and get Sagar to answer them. This week, we've got Varun Mundra from Bangalore who's asked, why should I invest in a PMS when there are so many mutual funds available?
Because we do a good job.
He's not saying your PMS, he's saying a PMS.
Okay, so I'll keep it short. A simple few reasons to consider a PMS over mutual funds. One is that you can get a customized strategy in a PMS which is catered to your needs, which will not happen in a mutual fund. A mutual fund is basically a basket of stocks where you just pitch in and get units of an existing fund. However, this is where a portfolio is managed, and if you have certain constraints or a style of managing, etc., or if you want the portfolio to fit in the overall scheme of things as well, the portfolio manager is able to construct a portfolio which is suited for your needs. So it is a very tailor-made product in that sense.
Understood.
Second is the timing of buying and selling is something that the fund manager controls in a PMS. So although you may invest that 50 lakh today, when a certain stock is being bought and what allocation is given to that stock at what point in time is better managed in a personalized manner for a PMS versus in a mutual fund. It will happen for everybody together. So for example, if a certain stock has gone 40% up, a user who came in 6 months back has that stock to the extent of 10% of their portfolio. The new guy, because it's gone so given that upside and the fund manager thinks there is limited upside from here, will take a truncated position or will completely avoid that stock altogether.
Understood.
So you're able to further optimize returns because of timing your entry, exit, and buying and selling.
Fair enough.
The third thing is that you can also take certain, you can invest in a staggered manner. So if you're investing in a mutual fund, all that money is invested into stocks directly at that point in time. However, in a PMS, you can probably take a call that I'll sit on 70% cash at this point because the markets seem very high, and slowly deploy that cash whenever markets take a downturn or I find an opportunity. So from that angle, you can further optimize returns.
Understood.
So I feel these are just three of the advantages of, I can go on and explain a few. But like primarily, I think these give a distinct advantage for a PMS compared to a
But essentially, I mean, if you had to summarize it, it's basically the main sort of proposition here is that it is customized for a particular individual.
Yeah.
Where a mutual fund is a suit you buy in a store, and this is a tailor-made suit for you, right?
Yeah.
That's the difference.
That's why there's also like a 50 lakh
Limit or minimum
so
ticket size. Yeah, fair enough. Hope that answers your question, Varun. Anyway, that's all for this week. Thanks a lot for listening. Please do like, subscribe. Let us know in the comments which companies you want us to cover next. And we'll see you next Tuesday. Thanks a lot.
Disclaimer. This content is for informational purposes only. None of the stocks, brands or products mentioned are recommendations or endorsements.